In the foreign exchange market, leverage acts as a mechanical amplifier. It is the most powerful operational tool available to you, but deploying it blindly is the primary reason new traders lose their initial capital. By the end of the session, we will walk step by step through a live trading dashboard to calculate your required margin, select a mathematically sound ratio, and lock in hard capital protections. To follow along and execute these steps, you will need access to a funded live or demo Forex trading account. For our baseline calculations, we will use a standard starting balance of $1,000. Trading this tool as a strict mathematical configuration rather than a speculative gamble is the dividing line between professional market participants and amateurs. Leverage allows a trader to control a massive financial asset while only putting down a fraction of the actual cash required to buy it outright. Think of it like a traditional real estate transaction. You might secure a $100,000 property using only a $10,000 down payment. In Forex, the exact same financial mechanic applies to currency pairs. This diagram shows that $10,000 block acting as your deposit. In the trading ecosystem, we call this margin. It is the precise amount of capital your broker requires to initiate and hold the position open. Consider a trader named David. He wants to execute a trade controlling $10,000 worth of currency, but his total available account balance is only $1,000. Grasping the theoretical ratio is relatively straightforward. However, surviving daily market fluctuations requires David to translate that broad concept into an exact mathematical formula before he enters the market. This calculator interface displays the exact formula you need to determine your risk. Trade size divided by your chosen leverage ratio equals your required margin. Let's apply this to a standard operational scenario. If you attempt to trade a $100,000 standard lot using a 1-to-100 leverage ratio, the calculation yields exactly $1,000 in required margin. The moment you open that position, your broker locks up this $1,000. You will see it isolated from your total funds and move directly into the Used Margin tab on your dashboard. This creates the primary failure point for new operators. If your total account balance is exactly equal to that required margin, meaning you had $1,000 and the broker locked up $1,000, your free margin instantly drops to zero. Without free margin to absorb standard daily market dips, the platform's automated risk system takes over. It will trigger a margin call, instantly liquidating your entire position to protect the broker from negative balances. To prevent this auto-liquidation, you must select the correct leverage ratio long before you open a trade. This split-screen candlestick chart illustrates a standard 50-pip market drop. On the left, we are operating in the conservative zone with a 1-to-10 leverage ratio. A 50-pip drop against your position barely registers, resulting in only a small deduction from your $1,000 balance. If we update that left side to a 1-to-100 ratio, the standard for many retail brokers, the identical 50-pip dip creates a moderate deduction. It requires strict operational rules to manage safely, but the account easily survives. Now look at the max leverage trap on the right side of the screen, operating at 1-to-500. The exact same 50-pip drop rapidly drains the entire account balance to zero. The position is wiped out in seconds. Beginners frequently default to these maximum settings under the false assumption that the broker is providing free money to generate larger, faster profits. Higher leverage does not alter the actual market movements. It strictly amplifies the financial consequences of those movements, turning normal, everyday volatility into sudden account-ending events. Let's physically restrict your risk exposure. Navigate to the Account Settings menu inside your trading platform. Click on Change Leverage. From the drop-down menu, select a mathematically conservative ratio, such as 1-to-30 or 1-to-50, and apply the setting. Return to your main dashboard and verify that the updated conservative ratio is properly reflected in your account summary panel. Next, open a new order window to set up your first protected trade. Notice the stop-loss input field highlighted here on the screen. This is your crucial final step. Before you ever click buy or sell, you must input a stop-loss order. This acts as a physical safety net that automatically closes your position if the market moves against you by a set amount. Combining a mathematically conservative leverage ratio with a hard stop-loss is the only definitive way to prevent leveraged losses from destroying your capital. You have successfully bypassed the max leverage trap, and your account is now configured for professional execution. Keep the golden rule of Forex in mind at all times. Leverage is a neutral multiplier. It equally amplifies your wins and your losses. Amateurs use leverage to gamble on unpredictable movements. Professionals use it purely to optimize their capital, maintaining strict mathematical control over every single trade. If you are ready to master precision-based trading, subscribe to the Forex Alert. Practice your risk management, and we will see you in the next breakdown.